Most people will tell you you don't need 20% down to buy a home in Canada. And that's true, but just because you can doesn't mean you should. Because what they're not telling you is that putting less than 20% down can cost you tens of thousands of dollars over time. So in this video, I'm going to break down exactly how much you need for a down payment, when it makes sense to put the minimum, and most importantly, I'm going to show you a real side-by-side cost comparison so you can see exactly what each option will cost you, and why, if you can afford it, putting 20% down is usually the smarter move. If you're thinking about buying, you probably ask yourself, do I need 5%, 10%, or 20%? Should I wait and save more? Or should I just get into the market now? And the problem is, most people get conflicting advice. Some say, just get in with the minimum. Rent doesn't build equity. Prices will rise. Higher prices means higher down payment. If you can afford the payments, just do it. And another common one is, you can get a higher return by putting the difference in other investments. While others say, wait until you have 20%. You'll qualify for more. You'll pay significantly less interest. You should avoid mortgage insurance, and your payments will be lower. So it creates confusion, and more importantly, it can lead to wrong financial decisions. Stay with me, and I'll walk you through how down payments actually work in Canada, what happens when you put less than 20% down, the real pros and cons of each approach, and how to decide what's right for your situation. Let's start with the biggest misconception. You do not need 20% down to buy a home in Canada. You can buy with less, and you don't even have to be a first-time buyer. But there's an important distinction. If you're buying an investment or rental property, you'll need 20% down because those are not eligible for mortgage insurance. But if you are buying a primary residence, you can buy with as little as 5% down. Now here's the catch. If your down payment is under 20%, mortgage default insurance becomes mandatory. And this insurance protects the lender, not you. The cost typically ranges between 2.8 to 4% of your mortgage amount. And the less that you put down, the higher the premium. So if you're putting down only 5%, you're paying the highest insurance at 4%. And here's what many people don't realize. That cost gets directly added to your mortgage, which means you're paying interest on it from the very beginning. Now, this doesn't automatically mean it's a bad move, because in some cases, getting into the market sooner can outweigh that cost, but it's case by case. Now let's break down the actual rules. Canada has federal minimum down payment rules, 5% on the first $500,000, 10% on the portion between $500,000 and $1.5 million, and 20% on anything above $1.5 million. So this is a tiered system. So for example, if you're buying a $750,000 home, 5% on the first $500,000 is $25,000, and 10% on the remaining $250,000 is $25,000, making the total minimum down payment $50,000. If you're under 20%, the mortgage must be insured through CMHC, Sagen, or Canada Guarantee. And again, this applies to anyone buying a primary residence, not just first-time buyers. Putting less than 20% down can have advantages depending on your situation. So first, it allows you to enter the market sooner. Saving 5 to 10% is much faster than saving 20%. Second, it requires less cash up front, so you can keep money for closing costs, moving expenses, renovations, and an emergency fund. Third, it gives you more flexibility. So instead of locking in all your money into a home, you can invest or keep liquidity. And fourth, insured mortgages can sometimes come with slightly lower interest rates. You may have heard that insured mortgages have better rates. And that's true, because when a mortgage is insured, the lender is protected against default, and the insurer reimburses the lender for any losses. But what's often misunderstood is this: a lower rate does not automatically mean you're saving money. Because remember, you're paying a mortgage insurance premium, and that premium is added to your mortgage. So you're paying interest on that premium over time. So in many cases, even with a slightly lower rate, your total cost can still be higher. And that's exactly what we're about to break down in a few minutes. But first, let's get clear on another key term you'll need to know in order to fully understand the cost comparison. Amortization. Amortization is simply how long you take to pay off your mortgage. So traditionally, insured mortgages were capped at 25 years, and uninsured mortgages could go up to 30 years. But recent changes now allow first-time buyers and buyers of newly built homes to access 30-year amortization, even with less than 20% down. And this is important because a longer amortization lowers your monthly payment, it can increase your borrowing capacity, but it increases your total interest over time. So yes, it improves affordability, but it will cost more long-term. Now, this is the part that most people never actually see. And this is where the decision becomes really clear. So let's compare two scenarios using a $750,000 purchase. For scenario one, we're going to use 20% down, amortized over 30 years. Your down payment would be $150,000, your mortgage would be $600,000, no insurance is required, and let's say a fixed rate of 4%. Your monthly payment in this case would be approximately $2,900, and total interest would be about $427,000. In scenario 2, using minimum down payment amortized over 25 years, your down payment would be $50,000, a mortgage of $700,000. Your insurance would be approximately $28,000, making your total mortgage $728,000. And let's use the same fixed rate at 4%. You get a monthly payment of approximately $3,800 and a total interest of $421,000. Now, this is where a lot of people get misled. At first glance, it looks like the interest isn't that different, but this is not an apples to apples comparison. One is 25 years and the other is 30 years, so of course the interest looks similar. But here's what actually matters. Your monthly payment is almost $1,000 higher, your mortgage is significantly larger, and you're paying insurance plus interest on it. That's what creates financial pressure. Now, let's compare using a 30-year amortization. Let's assume you're a first-time home buyer or buying a new build and you're qualifying for a 30-year amortization, even with the minimum down. So let's see what happens in scenario 2 with the minimum down payment if we swap the amortization to 30 years instead of 25. So your down payment would still be the same at $50,000. You get the mortgage of $700,000. Insurance and total mortgage is the same, and the fixed rate of 4%. So your monthly payment in this case would be $3,500, and your total interest approximately $518,000. Now this is where things get real. Remember, in this scenario, you have a smaller down payment, larger mortgage, added insurance, and because of that, you end up paying almost $100,000 more interest over time. And this is why if you can afford 20% down, it's more often the financially efficient decision. Remember what I said earlier about the insurance premium in the range of 2.8 to 4%? Well, here's what that looks like. 5% down means 4% premium added to the mortgage. 10% down, it's a 3.1% premium. And with 15% down, it's about 2.8% premium. So even increasing your down payment slightly can save you thousands. All right, so when does putting a minimum down payment make sense? Here are some examples. Number 1, you want to enter the market sooner because home prices are rising and waiting could cost more than the insurance. 2, you don't want to delay 2 to 5 years to save 20%. Time in the market may outweigh saving a larger down payment. 3, you need to preserve cash or liquidity. So for emergency funds, renovations, closing costs, or other investments. And 4, your income is expected to increase and you believe future earning power will make higher payments more manageable. 5, you have strong cash flow but limited savings. So basically you can afford the payments, you just haven't accumulated 20% yet. Number 6, you want to keep money invested elsewhere because opportunity cost of putting all funds into a home is too high. Number 7, you're buying in a fast-moving or competitive market. In this case, waiting may price you out. This is where strategy matters. Now, I can't talk about down payment without mentioning these 2 powerful tools to help you build your down payment. In Canada, there are 2 government-backed programs you can use if you're a first-time home buyer: the FHSA and the RRSP Home Buyers Plan. The First Home Savings Account, FHSA, offers tax-deductible contributions, tax-free withdrawals up to $8,000 per year with a total of $40,000. The RRSP Home Buyers Plan allows tax-free withdrawals up to $60,000 per person, but it must be repaid over time. FHSA should be used first, and then the RRSP. Using both allows couples to access up to $200,000 combined. Understanding how these work can literally mean tens of thousands of extra dollars towards your purchase. So make sure to check out my video, FHSA versus RRSP Home Buyers Plan next. If your goal is to reach 20% faster, here are 6 strategies. Number 1, track your budget meticulously using apps or spreadsheets. 2, start early and get mortgage advice 1 to 2 years in advance. 3, allocate all extra income to savings. 4, automate transfer of savings right after payday. 5, use bonuses, tax refunds, and gifts entirely for savings. And number 6, delay large discretionary purchases early on. These decisions can accelerate your timeline significantly. Instead of asking, what's the minimum I need? Ask, what puts me in the strongest financial position? If you can afford 20% down, it will often lower your payments, reduce your risk, and save you money long-term. But if it delays you too long, then strategy becomes important. If you walk away with anything from this video, it's this. Smart home buyers don't just chase a 20% down payment. They make decisions based on their goals, their savings, and what actually fits their budget. They understand that your down payment affects everything: your mortgage size, your interest costs, and how much flexibility you have month to month. So instead of stretching themselves just to hit a number like 20%, they focus on buying something they can comfortably afford. Because at the end of the day, it's not about hitting an arbitrary target. It's about making a smart, strategic decision that sets you up for long-term financial success.